Welcome and thank you for participating in today's meeting for the South Coast Air Quality Management District. If attending in person, please do not connect to Zoom or teleconference while in the room. To prevent disruptions, please silence all devices. All participants on Zoom, except for board members and South Coast AQMD staff, will be placed on mute. You will not be able to mute or unmute your line manually. After each item, public comment will be taken. If you are participating in person and wish to comment, please use the iPads which are located in the lobby if the meeting is in the auditorium. For meetings in other locations, please complete a blue speaker card and provide the card to a South Coast AQMD employee. Information on how to participate in the meeting in Spanish using a telephone will be provided at the end of these housekeeping remarks. Speakers may be limited to a total of 3 minutes or less for all items on the agenda. The amount of time to comment may be shortened to ensure all speakers can be heard. A countdown timer will be displayed on the screen for each public comment. If interpretation is needed, more time will be allotted. For questions or issues related to making public comment, please call the public advisor at 909-396-3247. That's 909-396-3247. In terms of decorum, if this meeting is taking place in the auditorium, no food or beverages are allowed in the auditorium. In accordance with state and local public health department guidelines, people may choose to wear a mask based on personal preference while in South Coast AQMD facilities. Please adhere to the speaker time limit and treat others with courtesy, civility, and respect. Failure to do so can result in your mic being muted or you being removed from the meeting. Lastly, be aware that this meeting is being recorded. By participating, you agree to authorize recording of audio and visual content presented during the live event and consent to subsequent use of the recording in the public domain by South Coast AQMD.
Good morning, everyone, staff, fellow committee members, public, consultants. I'd like to welcome you all to the Hybrid Investment Oversight Committee meeting for Friday, December 8th, 2023. I'll ask Geneva Pierce, our staff member, to please take the roll.
Supervisor Hagman.
Here.
Board Member Padilla-Campos.
Here.
Councilmember Salache is absent. Richard Dixon. Jill Wynot is absent. Chair Cacchiotti.
Here.
We have a quorum.
Thank you, Geneva, very much.
Thank you.
Perfect. Let's move on. Item number one is we have 3 discussion items. First one is quarterly report of investments. No motion required. Chief Financial Officer Sujata Jain, go ahead, please.
Good morning, Chair and members of the committee. Sujata Jain, Chief Financial Officer. This item is to report the cash balance in the LA County pool surplus and the special purpose investments. As of the end of the third quarter that ended on September 30th, 2023, the balance was $1,275,444,561.15. The composition of the investments are 93% in the LA County pool surplus and 7% in special purpose investments. And the earning rate for the month of September was 3.78%. And then on page 4 of the report, we have a comparison with of the yield with other counties, and we're kind of in the similar ballpark. And with that, I'll be happy to take any questions on this item.
Committee members, any questions? Seeing none from Supervisor Hagman. Board Member Padilla-Campos.
Not for me, thank you.
Okay, I just have one, and it's regarding the, I would ask this question on page 3. It's under our special purpose investments. If you go to page 3 and go down under U.S. Treasury as of September 30th, this is really exciting. We have a $40 million treasury. Looks like it's maturing in 2 months, in February 29th. That was, boy, I look when we bought it in 2022, 1.73 interest. That's when it started shooting up. What are your plans for that $40 million? Because if I'm adding right, tell me if I am, at $1 million, if we were at let's say we're 1.1%, that's $10,000. But if we're at 4 or 5%, that's $50,000 for every million times 40. That could be 1.6, 1.8 million, right? A year.
Correct.
So what are we thinking about doing with that $40 million?
So that's a very good question, Chair Cacciatti, and I was also looking at that. And most likely, those funds that, this comprises of 2 or 3 funds. And we think that there's still excess. So we'll probably reach out to LA County and reinvest those. And, I discuss from time to time with Wayne as to, if there's surplus based on our cash flows, which is the next item that we'll talk about.
Right.
And if there is an opportunity, we reach out to the program staff and make sure that if we lock it down for, say, another year, is that okay? And, generally, either it's not okay because there's some spending plan, or it's okay. So the funds that are currently sitting in those investments that are going to mature in February, most likely there is an opportunity to reinvest those.
And just among my fellow, like Kurt or Veronica or Wayne, with that 40, that's a lot, $40 million. And if I was just at the bank looking at CDs and treasuries, or, as your shows right here, the 12-month treasury bill at 5.46%. We can take that 1.73 up to 5. I know it may drop in February. There's predictions it may drop a little, but still I think it'd be about 5%. That's huge. And if we're looking at tight budgets right now, if we can reinvest that and maybe even, I don't know how we can take anything out of LAIF a little more. If we keep our liquidity, look at every opportunity with rates this high, that's really great.
Yes, and the general fund, we have some money in LAIF for diversity and in the special purpose funds. So what you're talking about, the extra yield, it certainly helps in the general fund, particularly for our operations and, the tight budget. So we will definitely be looking to reinvest that in a higher yield.
Thank you. Any follow-up question?
If you had your crystal ball, generally on major election cycles a year from now, if you have high inflation, high interest rates, things don't go well. So, from my cynical point of view, I see interest rates dropping down several times next year. I'm just wondering if that's what you guys counting on too. A few points.
I'm going to look at our consultants. Maybe they can, they'll be talking about interest rates and, where it's going, down the line, maybe in the next 12 months. So Richard can talk about that.
Do you want to wait for that, for Richard to talk?
That's fine.
I think that's a great idea. I'd like to hear that too. Great.
Yes.
Any more questions on this item? Quarter report of investments. Seeing no hands raised and nobody in the auditorium. Anybody online, Paul? Do you see anybody online?
There is a hand
Yeah.
raised,
Yes.
and it's the person with their phone number, last 3 digits, 529.
Okay, if you're 529 last digits on your phone number, please go ahead, please, and identify yourself, and you can testify for 3 minutes. Go ahead.
So apparently it's Mr. Dixon, who's a member of the
Oh.
committee.
Okay.
I'm not sure why he has his hand raised.
We can't move him over because maybe we haven't moved him over.
Richard, can you hear us?
Let's unmute him, please. And this way he can speak.
He has to press *6 to unmute. He can talk if he unmute himself.
Thank you. This is Richard Dixon. I had no questions. It was a good report and an interesting discussion. I think we may see some days of better returns.
Thanks, Richard. Okay, we'll move on to item number 2.
Thank you.
Thank you.
Item number 2, this is cash flows. This is a projection of our cash flows for the next 36 months. We are required to do a cash flow every 6 months. And the next will be at our June 2024 meeting. The lowest cash for all the funds will be 475 million in October of 2026. We can invest about 75% of this balance in our special purpose investments, which is approximately 356 million. Currently, we have invested about 90 million in the special purpose investments. And with that, I'll be happy to take any questions on that.
Committee members? Ms. Padilla Campos or Richard Dixon, any questions?
None yet. Thank you.
Mr. Dixon, any questions for staff?
No questions.
Thank you. Any public comment on this item? I see none in the auditorium. Mr. Glazier's back there looking at us, but no public comment. Tom, none? None weighing online? Okay, then thank you very much, Sujata. Great presentations.
Thank you, Chair.
And we'll move on to item number 3, the financial market update. No motion required in that by Richard Babb. And Richard, keep in mind when we get the discussion on the future interest rates, Supervisor Hagman wanted some information on that. We may have some questions. Crystal ball.
Good morning, Chair and members of the committee. And when I do start again, as much as I would like to have a crystal ball, if I had one, I'd be on my yacht right now, and I'm obviously not on a yacht. But it is a very good time to have this discussion, and it's interesting how things have changed since early October to now. So this report's really sort of focusing on September, the quarter ending, but we'll talk about a lot what's been happening recently. So in the third quarter, it appears that we reached peak interest rates on a strong economy, strong labor market. Inflation was stubbornly persistent, even though it had been moderating. But more recently, we're seeing signs of softening in the economy, signs of softening in the labor market, and more moderation in the inflation numbers. So in some ways, it's a good picture going forward, but it does mean, as we'll talk about, interest rates going down. Go to the next slide. This sort of talks about the conditions. It's in the agenda package, so I won't read them. This is sort of what was happening there. If we go to the next slide, we're talking about, inflation remains the key story. A couple of things. The chart on the table on the right is the numbers as of September, and the inflation rate on a 12-month number was 3.7%. If we were to bring it forward to October, which was released after this, that the year-over-year number came down to 3.2% number. A lot of that was actually driven by energy prices coming down and having an overall impact on that. But again, overall inflation is coming down. Core, excluding food and energy, still elevated at 4%, but the month-over-month number was only about 0.2%, which would annualize to about 2.4%. So roughly in where the Fed's target is. The chart on the left, what I want to sort of reinforce is, even though we're seeing inflation on a change rate come down, it's important to remain that prices remain elevated where they were a couple of years ago. So the impact on people's pocketbooks and everything else in budgets is still a serious consideration, even if the rate of change may be moderating. If we go to the next slide, this is the Fed's preferred measure of PCE inflation. It's a more comprehensive measure, but over time, it sort of averages what CPI is. And a couple of sort of consistent stories that we're seeing is that the service sector remains elevated. In September, it was 4.7. In October, it came down to 4.4. That consists a lot of shelter and wage-driven components of the economy. So those take more time to adjust, to sort of soften again. If you look at the goods part of it, that darker blue line, it was 0.9% in September. It's 0.2% in October. So again, you're seeing moderation, and the overall PCE number is only 3% overall. So again, the basic story is there are elements that are remaining a little higher than the Fed wants, but overall it's moderating. And to the next slide, I won't go in this much detail, but this is the producer price index. So the concerns are producer prices are elevated, it'll work its way through the economy. But what we're seeing is that producer prices remain fairly moderate. It was 2.2% in September. It came down to 1.3% in October. So again, that's a positive sign in the sense that inflation doesn't seem to be accelerating. Yes, parts are still too high, but overall it appears to be moderating. The other aspect is, if we go to the next slide, is that the labor market has been remaining very strong. And these were the numbers through October. And what was interesting is the October number, we saw that there were 150,000 jobs down, which was a decrease from 262,000 jobs in September. And the unemployment rate went up to 3.9%. So more softening. What we see, though, is if we took it out to the jobs report that came out this morning, the unemployment rate actually dropped down to 3.7%, and the number of jobs went up to 199,000, which was a little more than expectations. What was interesting is that if we average the jobs per month over the past 12 months, it's 240,000. So we are seeing moderation in the employment, but it overall remains strong. So a lot of economists feel that it's not a weakening job market, but so more we're getting in balance more, that the number of jobs opening and unemployed people are coming more in alignment, which from an inflationary standpoint would have a positive impact, so that there won't be as much demand for labor. And if we go to the next slide, the chart on the left, what we wanted to show is, in a sense, how we could look at purchasing power of consumers. And the blue line shows wage growth on a year-over-year basis, and the red line shows the inflation rate on a year-over-year basis, and the shaded area is just the delta between that. So in a sense, on a general basis, you would like to see people's wages exceeding wages, so purchasing power continues to grow, that they have able to spend and support the economy. What we saw is that when inflation peaked up very rapidly, that wages obviously lagged. There are a lot of reasons for that. Your salary isn't adjusted on a month-to-month or a day-to-day basis. It takes time for contracts to be renegotiated. We've seen a number of strikes in the recent past as people have tried to readjust to that. But what we've seen recently is inflation is moderated, as we've talked about, but wages on a year-over-year basis have increased. So again, we're seeing a positive sign on that. Again, it means to a certain degree there's stickiness in inflation, but it means a positive sign that consumers' purchasing power is increasing. And some of the things that are contributing to that situation are on the right. These were as October, and again, the unemployment rate, 3.9%, came down in the latest report for November to 3.7%. The excess job openings, about 3 million, is come down a little bit. So now there's only about 1.3 jobs opening for every unemployed people. Still a positive number, but again, maybe more in balance. The October number, as I said, was 150,000. It reached up a little bit to 199,000, a little bit above expectations. So generally a strong, healthy labor market. If we go to the next slide, personal savings, one of the things that's been driving the economy is people have been spending. So the chart on the right, we're showing personal spending. And in the September number, it was a very strong 0.7% on a month-to-month, 0.7% on a month-to-month basis. It decreased in October to 0.2%. Again, there's some of this is just timing of where money is spent, but again, people may be moderating some of their spending after a very strong third quarter. Personal savings have come down, so in a sense that people don't have the excess savings they had in the pandemic and coming out of the pandemic to continue to support economy. And also, as wages come into balance with inflation, that should require people to draw down less on their savings. If we go to the next slide, the third quarter, as I was talking about, was a blockbuster quarter in terms of overall growth. In this chart, what we show is that the GDP in the third quarter grew at 4.9%. That was the advanced number. We actually got a second reading of that. In the reading for that is 5.2%. And that's the fastest quarter we've had, like you said, since third quarter of since 2021. So again, and that was coming out of the pandemic, where we had a significant rebound. If you look in the table on the right, the key driver of that was consumer spending. While that number was revised downward in the second number and other numbers revised upward, it still remained the primary driver of economic growth in that. Thinking forward, though, that's not expected to continue. So for example, the Atlanta Fed's current estimate of fourth quarter GDP, again, it's a running estimate, not a forecast, is that it'll come in at about a 1.2% number based on economic data to date. And most economists see the economy slowing into next year. The current sort of consensus, not everyone's in this camp, but the current consensus is that we're more likely to have either a soft landing, no recession, or even if we have a recession, it would be very mild compared to what, the Great Recession or the pandemic and those type of things. It'd be more of a garden variety, sort of a slowdown in the economy rather than a severe contraction. And that's sort of what the economic data is leaning to. And that sort of echoes what we're seeing in Southern California. Again, this is national, but again, the SCAG put out its numbers and sort of seeing that the economy will probably slow to about 1% by the middle of 2024. Again, below potential, but again, not a severe recession. The one caveat I would have to this is this sort of indicates continuation of basic trends. But there are underlying factors that, if bubbled up, could actually have a more negative impact. For example, we still have issues with commercial real estate. We still have issues with banks with significant unrealized losses on their balance sheets. We have geopolitical events such as Ukraine and the war in the Middle East that could disrupt basic economic trends and cause more significant disruptions. I'm not forecasting that, but in the back of your mind, it's always important to think basic trends can be upset, as we saw with, for example, in the pandemic. If we go to the next slide, these are the Fed's forecast. And what's important is the Fed will have its next meeting next week on the 12th and 13th, and they will update these forecasts. So these are as of the September forecast. We also included the lighter colors, the June projections that they had. And the biggest change in this was in that upper left-hand corner. When we were entering 2023, it's not on the chart, but the Fed was suggesting that for the entire year, we would see about 0.4% growth in GDP. And then in their June forecast, they upped it to basically 1%. Now their September forecast for the entire year, not for one quarter, is 2.1%. It will be interesting to see what they say in their next meeting, like I say, next week. As far as the unemployment rate, they were suggesting it would be about 3.8% at the end of the year. Right now it's 3.7, it's 3.9 in the prior month. So it's about 3.8%. You'll notice that they're actually seeing higher unemployment by a moderate amount in 2024 and 2025. They still see the labor market's not quite in balance and would like to see the unemployment rate go up. I remember when I entered my career, 5% was sort of considered low unemployment. So again, we've had extraordinary low employment by historical standards. Bottom left-hand corner, PCE inflation. The Fed was thinking that it would end the year a little higher than they originally thought at 3.3%. But what's interesting is their latest numbers that it's actually 3%. So inflation has moderated more than it originally anticipated. And we'll see what their forecast was for going forward, because they were suggesting it would really be 2026 before inflation was really solidly at that 2% target. And what it meant for Fed funds rates is, and that's their short-term benchmark rate, they were suggesting in their September projections that there'd probably be one more hike this year in the Fed funds rates to bring it up from the 5.1 level to the 5.6 level on an effective basis. We haven't seen that. No one's expecting a rate hike at the December meeting. In fact, the market discussion is how quickly and how significantly will the Fed be cutting interest rates. UBS put out a study recently that was saying that they would see the Fed funds rate coming down by about 2% in 2024. They're a little more on the extreme. But again, a lot of market participants are expecting rates to come down by 1 or more percent. But you look at this chart, the Fed's really suggesting a very moderate cut in interest rates. So that's sort of what the balance is. What will the economic data show, and how fast will the Fed cut interest rates? If I go to the next slide, I'm not going to read all of these. In fact, if we go to the next slide also, it's talking about Fed speak. So what the Fed members have been saying about interest rates. And one of a common theme is that they see things coming back into control as far as inflation, but they really don't want to declare victory over it. So while the market is suggesting that economics conditions will allow them or force them to cut interest rates fairly rapidly, I think the Fed's very hesitant to do so until it really sees things go consistently. The Fed was late to fighting inflation, so they don't want to be too early to back away from that fight and have it re-peak up again. If we go to the next slide, the chart on the left is the Fed funds rate. And like I say, when this projection was done, that light blue, the projection of where the Fed funds rate was actually, we would have one more hike. If I were to continue today, that light blue line would actually be cuts. But you can see how high the Fed funds rate is relative to recent history. So while we do see interest rates coming down, remember that the Fed would like to bring interest rates back long-term, the Fed funds rate, from about 5.1% to about 2.5%, lower than it is now, but again, much higher than we've had for most of the time since the Great Recession. The chart on the other aspect is that the Fed funds balance sheets. The Fed had done significant quantitative easing and since buying bonds of various types to affect more longer term rates versus short term rates, which is the Fed funds target rate. After coming out of the Great Recession and in the pandemic, as we can see, they're trying to back away from that and bring normalization to the overall bond market, which has put some upward pressure on longer term rates, because if they're not as an aggressive buyer, and we've also seen some backing out of the market from Japan and China, not buying as much, there's been some increase in longer term rates is because of that. So if we go to the next slide, and this alludes to the question earlier, what interest rates are going to do. The 1030 number, the far shaded number, was sort of near the peak of where the interest rates were, probably about 2 weeks before that. So the 3-month, which was 546, is at 539 right now. So as the market sort of anticipates the Fed's going to start cutting rates, that'll come down because it'll go into the 3-month horizon. If you go to the 2-year, it was at 509. It actually had been as high as 519. It's only 469 right now. So two aspects to that. And one aspect is if you're looking at reinvesting money, yes, you're going to get less money overall than you would, but you're still earning a very strong positive return relative to that. And economically, it could actually have some good positive effects, because every fixed income portfolio there is, whether it's banks, LAIF, your own portfolio, LA County, has significant unrealized losses because interest rates rose up so high relative to where interest rates would have been. As interest rates moderate somewhat, some of that unrealized losses come down. The other aspect is, even though if interest rates come down somewhat, it could still mean that the earnings on your overall portfolio, which still includes, as we saw, investments bought when interest rates were low, or as those mature and reinvest at new current levels, even if they're not at the peaks, they'll be higher than they would before and have a positive impact of that. We'll also see broader economic factors, that the 10-year Treasury, which was 493, is now at about 423. So from a mortgage basis, which a lot of them are based on the 10-year Treasury, those will come down and maybe have positive secondary impacts on the real estate market, which has been negatively impacted by higher interest rates. So again, my comment would be, we see lower interest rates going forward into 2024. The Fed's preferred path is to take a very moderate cuts in that you might see 1 or 2 cuts in 2024 versus 3 or 4 or more, as the markets may be suggesting. What will happen depends on what the economic data shows. So if inflation continues to moderate, we'll see rates come down. If we see the labor market soften, rates will come down. It's if the inflation heats up, we'll see inflation rates go back up, or if the economy craters versus a soft landing, we could see more significant cuts. And the next slide is just to give you a broader context of this. We're showing you the red lines, the 3-month Treasury. The 2-year is the blue line. And this sort of goes through November 15th. So you see sort of the peak in interest rates, and rates have come down since then by about 50 basis points for the 2-year. Again, we're down, but we're not down significantly. So again, we may have, it's, I think, a net a positive effect on that. You'll see that the 2-year is below the 3-month, and that's because the market's anticipating what the Fed will do over a 2-year period, while the 3 months sort of says, well, what's the Fed going to do in the next 3 months? And now as the market says, well, the Fed's not going to increase rates anymore, we'll start seeing that 3-month rate come down. Just as some additional slides as information I wanted to show you. On the next slide, we're talking about, what the economy is going to do. The probability of a recession fell. This is the New York Fed's based on the inverted yield curve. So again, it's just saying based on historical patterns, when we have an inverted yield curve, we'll traditionally have a recession 12 months in the future. What we saw is that it peaked and it come down fairly significantly. So right now, the Fed, if I were to bring it to today, is about a 50-50 chance of recession in the next 12 months. So it sort of echoes that story that people see things softening, but not necessarily coming into a severe recession. If we go to the next slide, the left chart is consumer sentiment. And what's interesting is consumer sentiment actually fell fairly significantly in the last number, but consumers continue to spend. We go to the chart on the right as far as inflation expectations, that long-term people expect inflation to get under control, but there's still some worries about that. And that will be important to see if the numbers continue to come down, inflation, so people's expectations come down. If we go to the next slide, a lot of data here, but on the chart is net percentage of domestic banks tightening standards. And what we see is that number above 0 is generally there is tightening of that there is forces in the economy that are trying to slow it down. And if we go to the right, is that the demand isn't as strong because it's 0 weaker demand. So again, we are seeing softening in the economy like it was before. If we go to the next slide, ISM manufacturing index. And what this is, anything above 50 is expansion in that area. Anything under 50 is contraction. Manufacturing remains contraction. It had a boost sort of in the pandemic period, but since then, it's sort of continued to softening. In the non-manufacturing or the services indicator, what we see is that it remains positive. In fact, in the latest number that came out since this report is up slightly to 52.7 from 51.8, so about 0.9%. So not as strong as maybe we had out of the pandemic, but the services sector continues to grow, which is a positive sign. And if we go to the next slide, same basic information, but market does their survey a little different. So again, the left manufacturing is from their perspective is neither contracting or expanding, and that we see a moderate, very slight expansion in the services sector. So again, a slower economy, but not necessarily a recessionary economy. And that concludes my prepared remarks, unless there are any questions.
Supervisor?
Back to my crystal ball. No, I appreciate it. It's always interesting to see this in context over, multiple years, if not decades, to see a lot of the numbers we see, like the job growth and stuff, is not necessarily because of a strong economy, is because they're the recovery from a very, hard COVID. So when you say you're adding X amount of millions of jobs, they're replacing the ones we lost during the previous couple of years of the COVID time period. And so it comes back to just trying to, look at that crystal ball and find out, I guess, and I'm thinking more of my supervisor hat, less than the AQMD director hat, because we have some funds, we're going to put it back in probably short term. Interest rates are good on the T-bills. We get some decent return on those dollars. But, globally, if we had that soft landing, is great. How long does it take us to fully recover and get back to a whatever quote normal time is, especially with 2 wars going on internationally and all the rest of it? But it's those predictions and trying to figure out where we should be looking at investing, where we should be looking at sharing up. We also had continue to have minimum wage increase. I'm looking at service inflation number. How much is that is natural versus the state policies taking effect on raising the wage rates, because we see that in a lot of our county employment and other ways too, with that pressure of moving. When you move one class of workers, the rest of them get pressure to go up. And this is like we're facing here at AQMD as well. It's like we're having this wage war, so to speak, to keep up with the inflation going up of real earnings. And all that stuff's very important for us as policymakers to try to figure out how to interpret and how to, stay ahead of the game, or at least match it when we go through whatever the negotiations we do with our labor groups, or also with our residents, trying to figure out what we can do to help them out. So I thank you for the information. I really no questions. It's not clear at this point, I guess. And I went through our SCAG Economic Summit yesterday, and it was 5 hours of the same thing. Nothing's clear besides housing's very costly right now for all of us, which makes that real earnings that you take home really pinching the pennies, because you're supposed to be at the 30% mortgage rate or housing costs, and we're up around 50 or 55 for our basin. So that's going to continue to put pressure on our employees and our residents to try to have a decent, quality of life type of thing. So I guess no questions. Thank you for the wonderful information.
Thank you.
Richard Dixon, any questions for staff or Board Member Padilla-Campos?
I always say this is my favorite report that I get. I don't know. I find it so interesting to see what's going on, and even with the uncertainty, it's good to kind of be aware of this, and it helps me in my career as well as here at AQMD. So just really appreciate the information. So yeah, just want to say thank you for that. But no questions.
Richard, any questions for staff or Richard Bob? You're on mute. Richard, I'll come back to you. I just wanted to follow up on Supervisor's question. Paul, if you could pull up Mr. Babb's report to page 14. And Richard, is a question I asked, it's kind of like the crystal ball with the supervisor, and a question I'd asked Chief Financial Officer Sujata. So, and I just want to get some ideas from the board members too. And Kirk kind of alluded to it. We've got money. We're going to reinvest it this next year. Paul, thanks. So perfect. You got the Treasury yield curve. And Richard, as you know, the question I asked on our Chief Financial, we've got $40 million maturing late February. Got a Fed meeting coming up December. Will there be one before that? Again, your prediction, I think the overall, as Kurt said, probably going to go down maybe. What would you do, and what would you recommend? And I want to hear from my fellow board members, as that 40 million, which is a lot. If you're considering still 4 or 5% interest, that's a lot. We want to really capitalize on that. What would you, and looking at those Treasury yield curves and predictions going forward, just 2 months away, 2.5 months, what are your thoughts of possible recommendations to our staff?
The key underlying thing always first is liquidity. When are you going to need to spend the funds? So again, don't want to buy a 2-year security if I'm paying payroll next week. I know that's extreme examples. Assuming that there are no specific liquidity needs for that, what I would say is that the yields on the 2-year, even though they're down from where they were at their peaks, are still above the LA County pool. And this would still be a good time to lock in some money for longer, if for no other reason to provide stability if rates come down significantly. In that balance type of thing. If I'm thinking, the thing you've got to remember though is it may not ultimately prove to be the best case. With short-term rates high, and if the Fed cuts rates very moderately as they're expecting, you could actually do better by reinvesting short at higher rates over that 2-year period, even if it ends up lower than the 2-year today. So again, there's no guarantee. Liquidity is the key aspect of it. On a balanced sort of situation, since you have a lot of liquid funds, if you can invest out some longer, not 5 years, but maybe 2 years or so, just to provide some stability if rates come down more significantly than the Fed anticipates, I think that would be a moderate approach. But again, you have to take the totality of what you're going to need your funds for and what other funds are available. Hopefully that was responsive to your question.
Yes, go ahead, Kurt.
I was going to say, we'll leave it up to staff to work with Wayne to figure out the cash flow over the next 2 years. You don't have to take the whole 40 million. We could put, 20 million in a 2-year or 10 million in a 3-month and keep 10 liquid if you need it. So there's a lot of combinations to look at. So.
Very good comment.
As we get to late December, you're sitting there together with all this information. Wayne, did you want to comment?
No, I think Supervisor Hagman's right on point. There are a number of things that I know the board has talked to us about in terms of various initiatives. There's always, equipment, capital improvements, things of the like. So definitely want to sit down with staff, hear from Sujata, and then bring back some recommendations to the board.
Okay. Any more questions from the committee members? Thank you, Paul. Richard, did you have any questions or comments? Richard Dixon, seeing none. Is there any public comment on this item? None here in the auditorium and none online?
Yes, I think it was a good presentation. I agree with our consultant. If liquidity permits, my guess today would be a 2-year investment might be very attractive. But if there's one thing we have to remember, between now and February, there may well be more changes.
Thank you, Richard.
Hello?
Yes, we hear you. Thanks, Richard. Move to item number 4, and that's the action item, approved committee meeting dates for calendar year 2024. And you've got to see the dates: March 8th, June 14th, September 13th, and December 13th. Is that good with all the?
I'll move it.
Okay. There's a
I
motion.
second.
Second by Dixon, moved by Hagman. Is there any public comment on this item? None in the auditorium. Wayne says none remotely. So roll call, please, Jenny.
Supervisor Hagman,
Agman, aye.
Board Member Padilla-Campos.
Aye.
Councilmember Salache is absent. Richard Dixon,
Aye.
Jill Wynot is
Yes.
absent. Chair Cacchiotti.
Yes,
Item passes.
thank you, Jenny.
Chair,
And
just a quick reminder that I would just be absent during maternity leave, but look forward to coming back as soon as possible.
which date would you be absent?
March for sure, and June maybe.
Okay. See how that affects our quorum. Thanks, board member. We'll move on to other matters. Number 5, any other business? Committee members? Committee members, any
No.
other business? Staff?
Chair, I just wanted to mention that we'll be polling the committee members as to potentially other times on those dates to meet rather than 8 a.m. I think there might be some flexibility, so we might be able to get a later start if that might be helpful, but we'll be polling and then coming back to you.
Great, that's a great idea. Thanks, Wayne.
Yes.
Is that okay with you, Richard?
Yeah.
Thanks. No other business, and we'll move to public comment period, item number 6. Any public comments? None here in the auditorium. Any online? Staff is shaking their head no. I don't see any hands raised. Then we'll go to the next meeting is Friday, March 8th, 2024. We'll check on that time. Without further ado, meeting is adjourned. Thank you.
You will, everybody.
Thank
Bye-bye.
you, and happy holidays and happy New Year.
Thank you. You too.
Thank you. Bye.